Alright, hey, what's up guys? Scott here again with my next live trading video, and this one here we're going to focus on how you should pick your covered call strike after getting assigned shares on your put option as part of an overall wheel strategy position. Right, so the whole point of the wheel strategy is to first sell put options so that you can eventually acquire stock at a very discounted price, and of course along the way collect some good premium. And then eventually when that does happen, once you do take ownership of 100 shares of stock, at that point you can switch and start selling covered calls on those shares of stock. So again, for this video here, we're going to focus on which strike might be best given the current state of your wheel strategy position. Now real quick here, make sure you guys watch until the end of the video because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks and each stock could be worth up to $2,500. And also for anyone who would like to join a very exclusive online community where you can really learn how to successfully trade options, then you can now join my options trading Discord. So make sure you guys check out the description of this video below because I do have a link to a separate video that will tell you all about that Discord and discuss the main features and benefits, and also a link to my sign up page where you can join and begin your 7-day free trial. And then finally here, for anybody who is brand new to the channel, again, my name is Scott, and you can also find me on Skillshare as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video below. So be sure to check them out, and when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Alright guys, so to demonstrate how to do this, we're going to take a look at one of my experimental wheel strategy positions on XOP here, which is what I'm showing in this chart. And so first up, just to give you some context around this trade, we'll go ahead and zoom in here a bit on the chart. And so as you can see here, very recently, XOP, which is pretty much the entire energy sector, that's what this ETF represents, has undergone a massive sell-off. And so I believe it was somewhere around this point when XOP came down and touched the 200 period moving average, which you can see right here in yellow. It was somewhere around this point where I sold a 116 strike put option. And that was basically the first step of putting on the wheel strategy for XOP here. And so for a couple days here, I was very happy to see that XOP was bouncing pretty nicely off this moving average. But unfortunately, fast forwarding to the present, that little bounce was totally undone and XOP fell a lot lower. So ultimately, as of last Friday, which was the July expiration date for my 116 strike put option, as you can see, XOP closed literally just 1 penny below my strike, so I did get assigned on that put option. Which means now, of course, my put option has disappeared, and I'm now long 100 shares of XOP at a purchase price of 116 per share. And so that's why today I'm looking to sell a covered call option on my long shares at this point. Now for me personally, the way I trade the wheel strategy is I pretty much only use the monthly contracts, mostly because those contracts are oftentimes much more liquid than the weeklies, and then also because, of course, trading monthlies requires much less management. Right? Otherwise, if I was trading weeklies, then of course every week I would have to either roll my contracts or sell covered calls and manage things much more frequently. And so that means, of course, now coming over to the trade tab for XOP. And so again, my original put option was in the July monthly contracts, which expired last Friday. So now I'm looking at the August monthly contracts with 32 days left to go. So we'll unfold that tab here and then scroll down to the near at the money options. And so when it comes to picking your call strike now, there are two major things you have to consider. Number one here is you have to consider your cost basis on acquiring these shares. Right, so even though my put strike on XOP was 116, so that's the price I bought these 100 shares at, 116, that does not mean my cost basis on the shares is also 116 bucks. Right, because again, you have to keep in mind the fact that when you do hold a put option or any short contract to expiration, you always keep the premium that you collected when first selling that contract. So for my case here, I sold my put option for a starting credit of 390 bucks. So that money which I now keep helps me reduce my cost on acquiring these shares. Right, so for example, if I go ahead and pull up the calculator real quick here. So again, if my initial put strike was 116, and if I also collected a credit of $3.90 on a per share basis, so we subtract 390 from 116 here, we get a result of $112.10. This is now my cost basis on those 100 shares. Right, because ultimately if I bought the shares at 116 and if I were to sell them at a price of 112.10 here, then of course I would take a loss on the shares of stock by themselves, but the credit I collected will totally compensate for that loss. So at the end of the day, I'll walk away with just a scratch. And so now when picking my cover call option here, of course, I'm going to collect some credit for selling that option as well. And so that also is going to reduce my cost basis too. So bottom line here, at minimum, I want to pick a call strike such that if I were to get assigned on that call option and have to sell my shares at that strike, then at minimum, I would at least walk away with a scratch on the entire wheel strategy position. And so again, this is going to require you to factor in your total cost basis on the trade. Now for this case here though, it's not so much of a concern because given the XOP at 121 almost per share, because the stock right now is above my cost basis of basically 112, then I can pretty much pick any one of these call option strikes, and still, if I get assigned by the expiration date, I'll still walk away with some amount of profit. So really the main issue here in regards to your cost basis is in the case where the stock is far below your cost basis, and we'll touch more on that particular situation later in this video. But then also here, the second main thing you must consider is the chart itself. So we'll come back to the charts here again on XOP and try to find a point of possible resistance on this chart, right? Because in my view here, when you sell cover call options, the main thing you want is for the calls to expire worthless. So that way you can sell a new cover call in the next cycle and just repeat the process, right? Otherwise, if you do keep getting assigned on your call options because the stock does continue to march higher and higher, that's definitely not a bad thing either. You will still make money, of course, if you keep your cost basis in mind, but still, you'll have to continually reacquire more and more shares over time at higher and higher prices. And ultimately, the stock price may at some point get too expensive for your account value to handle. So again, that's why in my opinion, it's simply the best possible scenario and it's easiest to manage the wheel strategy when your options simply keep expiring worthless every cycle. And so in this case here with XOP, there's a very massive breakdown candle right here. And if XOP were to continue marching higher and higher across the next couple days or weeks, I could see the stock or the ETF here possibly topping out at around the high of this candle here, right? Oftentimes when you see large breakdown candles like this, the highs of the candles can be significant points of resistance. And then conversely, for large break up candles, oftentimes the low of those candles can act as support. So now for my call strike here, I'm going to keep in mind this price of around 133-ish bucks per share. So ideally, I want to pick my strike to be a little bit above that point. So now we'll come back to the trade tab here and try to find a strike that makes the most sense. So again, 133 right here is pretty much the minimum strike that I want to pick. But I think just to give myself a bit more cushion, I'll sell the 134 strike. So now I'll click on the bid price for this option. That brings up a sell order down below. Just going to sell one contract to match my 100 shares of long stock. And the mid price for this contract is right around 235 or so. We'll lock in that price and then go to confirm and send. And also take note that the buying power effect for this trade is $0 because again, this call option is totally covered by my long shares of stock. So now we'll just go to send. And no fills yet on this order, so we'll come back to the monitor tab and perhaps change my price a little bit. There's my order here. So I'll go ahead and right click and go to cancel and replace. And perhaps I'll come down to maybe 230. Try and get filled immediately here. Confirm and send and send. And there we go, just got filled and price improved to 233. Awesome. And so now, if I bring back the calculator again, let's now take a look at the full picture of this position now. And so as I showed you earlier, my cost basis before I sold this call option was $112.10. And then now, as you just saw, I sold this call option for a credit of $233, which on a per share basis is $2.33. And so that further reduces my cost basis on this trade down to $109.77 per share. So again, this means this is the lowest price I could sell my shares at and still break even on the entire wheel strategy position, right? Because once more, I bought them at 116. And if I ever were to sell them at 109.77, then the losses I would face on the sale of stock here would be totally compensated by the total credit I've collected at this point in the trade. Right, the premium from the put option and also the premium now from the cover call option. And finally, of course, if XOP were to actually rally all the way through my call strike by expiration at 134 here, and if I then got assigned on this contract and had to sell my shares at a price of 134, that definitely would not be a bad thing. right? Because in the end, with my cost basis at 109.77, and if I then sold the shares at a price of 134, that would be a profit of $24.23 per share times 100 shares. That's a full profit of $2,423. But now what about the case, as I was kind of talking about earlier, if the stock does drop significantly below your cost basis? Well, as you're going to see here, it's not always possible to pick a call strike that's actually going to be profitable if you do get assigned at that strike. So for example, at this point, let's now come over to AA, which is Alcoa Corporation. And as you can see here, also in the August monthly cycle, I am still short a put option, or two put options actually, that are super far in the money right now. So the strike, as you can see here with my puts, is 75, but right now Alcoa is all the way down to 44 bucks per share. And so what I've been doing to manage this trade is I've simply been rolling my put options again and again to the next and next expiration cycle. So this trade actually began a few months ago, but ever since I put on the trade, Alcoa has simply dropped more and more and more. And so at this point, after many rolls of these put options, my total collected credit at this point is 1,160 bucks, right? Because again, every time you roll your contract to the next cycle, you should collect at least a small amount of credit. And so now here, let's do some basic math to figure out the current state of my position and basically show you why I have not taken assignment on these put options and tried to sell cover calls yet. So again, as I said, my total collected credit on this trade is 1,160 bucks. And we're going to divide that by 2 because again, I'm also short 2 of these 75 strike put options down here. So basically 580 is my total collected credit per contract, which then if we divide by 100 to get this on a per share basis is $5.80. So ultimately, this means my cost basis per 100 shares or per contract basically is 75 minus 5.8, which is 69.2. So this here is the lowest price I could sell my shares at if I were to get assigned on my put options and therefore have to buy them at 75 bucks per share, right? So again, $69.20 is the lowest possible price I could sell them at and still break even on the full trade. So bottom line here, this means if I were to sell some covered call options, I would likely have to pick my strike to be somewhere around 69 or 70 bucks. Which, as you can see here, the 70 strike call options are only trading for a price of around, going right in between the bid and the ask, call that $10. $10 per contract. And the reason why I can't go lower than this, and perhaps sell maybe the 50 strike call options for a lot more in credit, in this case here, around 155 bucks per contract, that's pretty nice, but again, the strike here of 50 is way too far below my cost basis. Right, so once more to illustrate here, once more this is my current cost basis, but again, if I sell these 50 strike call options for around $1.55 on a per share basis, that reduces my cost even further down to $67.65. But like I was saying, if I got assigned on these call options here and had to sell my shares at a price of only 50, then in that case, I would take a loss of exactly $17.65 per share times 200 shares. That's a full loss of 3,530 bucks. Now I still will say though that in some cases you may want to still consider selling your covered call strikes below your cost basis if you simply want to do some damage control, right? Because even though you would take a loss on the trade if you did get assigned on the calls, but it would still be a much smaller loss than what you have on right now. But for this trade in Alcoa here, I am still hopeful that at some point this stock will recover. So that's why for the time being, I'm just going to continue rolling my put options again and again to collect more and more credit. And at some point, if the stock can rally a little bit more, at that point, maybe I will take assignment on my puts and then switch to selling covered calls once the covered calls I can sell are worth a lot more in premium. And so with that being said, that's going to do it here for this video. But one more thing, as I mentioned, I do have a very cool limited time opportunity where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and sign up for my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.